Did you know that investing just $100 a week into SCHD could eventually generate more income than the average American salary? This strategy relies on the mathematics of compound returns, consistently building wealth over time. I've analyzed the actual growth progression using SCHD's documented 12.83% historical returns, a rate that dwarfs typical 3% annual salary increases. By year 5, your $400 monthly investment could be worth nearly $30,000 and generating over $1,000 yearly in dividends. The truly transformative results appear when you maintain this discipline long term. Later in this video, I'll reveal the exact point where this modest investment strategy begins to replace your regular paycheck. What if I told you the path to replacing your salary isn't about working harder, but investing smarter? Let's do the math together. Most people spend their entire lives trading time for money, but there's a financial vehicle that can potentially turn this equation on its head, and it's accessible to almost anyone willing to be consistent. Enter the Schwab U.S. Dividend Equity ETF, commonly known as SCHD. This powerful wealth-building instrument has delivered an impressive 12.83% annualized total return throughout its 13-year history. Think about that for a moment. While you're working hard for that annual 3 to 4% raise at your job, this ETF has been generating returns 3 to 4 times higher. The contrast becomes even more striking when you compare SCHD's performance to traditional savings accounts. Many people still park their hard-earned money in accounts yielding less than 1%, essentially watching their purchasing power erode due to inflation. Your money deserves better treatment. Now let's see how SCHD turns those modest returns into real growth via reinvested dividends. What makes SCHD particularly attractive is its carefully selected portfolio of dividend aristocrats. Companies like Texas Instruments with its 2.6% yield. That's $26 annually on every $1,000 invested. Amgen offering a solid 2.9% return, and household name Pepsi delivering a steady 3%. These are established businesses with strong fundamentals and proven track records. These companies systematically increase their dividend payments year after year, creating a double growth mechanism. Like a snowball rolling downhill, not only does your portfolio value increase over time, but the actual income stream it generates continues to expand as well. It's like getting a raise without having to ask for one. The beauty of this approach is its accessibility. We're talking about investing $100 weekly, which adds up to about $400 monthly. For many people, this is roughly equivalent to skipping a few restaurant meals or passing on that daily premium coffee. It's not about drastically changing your lifestyle, but rather redirecting some discretionary spending toward your future self. When you consistently invest this amount and reinvest the dividends, the power of compound returns kicks in. Each dividend payment buys more shares, which then generate more dividends, which then buy even more shares, and on it goes. The mathematics behind this process is undeniable. While traditional savings grow linearly, investments with reinvested dividends follow an exponential curve. In the early years, the difference might seem minimal, but given enough time, the gap becomes enormous, like the difference between climbing a gentle slope and scaling an increasingly steep mountain. This exponential growth doesn't require you to become a financial expert or spend hours analyzing the market. It simply requires consistency, making those $100 weekly contributions regardless of market conditions or economic headlines. It's about trusting the process and letting time work its magic. The strategy removes emotion from investing. Instead of trying to time the market or chase the latest hot stock, you're systematically building wealth through companies that have demonstrated their ability to generate profits and share them with investors. It's about getting wealthy systematically. What's particularly satisfying is watching your passive income grow. Initially, those dividend payments might seem small, but as your share count increases and companies raise their payouts, you'll reach a tipping point where your investments generate substantial income without requiring any additional effort from you. Many investors abandon ship when they don't see immediate results. But the 5-year mark is where investment progress becomes truly substantial. Those initial dividend payments might seem like pocket change, but they represent the first visible signs of your money working independently for you. Let's track what happens when you consistently invest $400 monthly into SCHD. By the end of your first year, your portfolio will have grown to approximately $5,185. While this might not seem impressive, it's crucial to understand what's happening beneath the surface. Your investments are beginning to generate their first small streams of dividend income. And though these initial payments might barely cover a nice dinner, they represent the seeds of your future financial freedom. The beauty of this strategy reveals itself as we continue through years 2, 3, and 4. Each month, your portfolio grows from your fresh $400 contributions, market appreciation, and dividend payments that are automatically reinvested to purchase additional shares. This creates a subtle acceleration effect that most new investors fail to appreciate or have the patience to witness. By year 3, you'll notice your quarterly dividend payments growing more meaningfully. Each payment buys more shares, which generate more dividends in the following quarter. This self-reinforcing cycle is the essence of compounding, where your investment begins generating its own investment capital without requiring extra effort from you. The psychological impact of reaching year 5 cannot be overstated. After 60 months of consistently investing, your portfolio approaches the $30,000 mark, sitting at approximately $29,735. This milestone feels significantly different than the early stages when your balance was just a few $1,000s. At this point, market movements begin to impact your portfolio value more than your monthly contributions, signaling that your money is working harder than you are. What's truly fascinating is that by year 5, your dividend stream has grown into something meaningful. Your portfolio now generates around $1,029 annually in passive income, equivalent to approximately 86 hours of minimum wage work. That's essentially giving you more than 2 full weeks of freedom without lifting a finger. Your money has created a phantom employee who works those hours for you, depositing earnings directly into your account with no commute, no boss, and no sacrifice of your precious time. As that initial patience pays off, the growth becomes more than numbers. It transforms your entire mindset about money. The dividends have evolved from barely noticeable amounts to a meaningful sum that accelerates your portfolio's growth through a mathematical process most people never experience because they lack the patience to reach this point. The 5th year represents a critical psychological turning point for most investors. The accumulation has become substantial enough that you can clearly see the strategy working. Your initial faith in the process has been validated by tangible results, making it psychologically easier to continue the journey. This is also when the compounding effect becomes visibly apparent. In the early years, your contributions dominated the growth equation. But by year 5, your money has begun generating significant returns on its own, creating a second income stream that requires no additional time investment from you. While the changes at year 5 are impressive, they pale in comparison to what happens as your portfolio matures to the decade mark. By year 10, your money begins to develop a work ethic that would make even the most dedicated employee jealous. This is the point where your financial snowball transforms into an avalanche, a milestone most investors never witness because they simply don't stay invested long enough. Let's look at what actually happens to your portfolio at this critical juncture. After a decade of consistent $400 monthly investments, your account balance could grow to approximately $74,400. That's nearly 2.5 times the value you had at the 5-year mark. The total balance represents significant power working for you behind the scenes. Your annual dividend income would now be approaching $2,500. Think about that for a moment. That's equivalent to the earnings from a part-time job, except you don't have to clock in, deal with difficult customers, or ask for time off. This passive income stream represents over a month of expenses for many Americans, all generated while you're going about your normal life. When we break this down by the hour, the efficiency becomes even more apparent. If your $2,500 annual dividend income were earned at a typical $15 hourly wage, it would require approximately 167 hours of active work. That's over a month of full-time employment. Yet your portfolio generates this income whether you're at your day job, enjoying a weekend barbecue, or fast asleep at 3 a.m. Imagine the personal freedom that comes with knowing your money works continuously while you live your life. What's particularly fascinating is how your money has become increasingly self-sufficient. By the 10-year mark, your portfolio is generating enough new capital each year to cover an additional 6 to 7 months' worth of your regular $400 contributions. Imagine your portfolio as a silent business partner, handling more than half of the new investments automatically for you. The psychological impact of reaching this milestone is profound. There's something uniquely comforting about having a growing income stream that continues whether you're working, sleeping, or on vacation. This realization fundamentally changes your relationship with money and work. You're no longer entirely dependent on your next paycheck. You have a financial ally working for you around the clock. When we compare the growth from years 5 through 10 with the first 5 years, the acceleration becomes unmistakable. While the first 5 years built your portfolio to nearly $30,000, the second 5-year period added more than $44,000 in value. This isn't just growth, it's accelerating growth, where each passing year contributes more than the one before it. This acceleration happens because your reinvested dividends purchase more shares quarterly, producing their own dividends in a virtuous cycle. The size of your portfolio means modest percentage gains translate to larger dollar amounts, and increasing dividend income compounds more rapidly, creating an even stronger snowball effect. The journey transforms dramatically. In the beginning, growing investments was like pushing a heavy boulder uphill with minimal visible progress. By year 10, that boulder is rolling downhill on its own, gathering speed each month. Your job is simply to guide it in the right direction. Your investment strategy has created a self-perpetuating wealth machine with momentum that carries forward with increasing strength. That boulder rolling downhill doesn't just continue, it eventually transforms into a financial powerhouse that could genuinely replace your job income. But exactly when does this investment strategy overtake your salary? When does your money start working harder than you do? Fast forward to the 40-year mark of your investing journey. Your modest $400 monthly contribution, $100 per week, has grown into something remarkable. A portfolio worth approximately $1.48 million. The true power lies in what this portfolio generates automatically without any additional effort from you. Your annual dividend income would exceed $51,000, more than many Americans earn from full-time employment. Think about that for a moment. The equivalent of working 40-plus hours weekly for an entire year could be flowing into your account automatically, whether you're working, sleeping, or traveling the world. The key question is precisely when this financial transformation happens. There's a specific crossover point in your investing timeline when your dividends first exceed minimum wage earnings, then match entry-level positions, and finally surpass professional salaries. Picture receiving your first paycheck entirely from your portfolio rather than your workplace. That moment represents financial freedom in its purest form. While $51,000 4 decades from now won't have the same purchasing power due to inflation, quality dividend stocks like those in SCHD typically increase their payouts over time, often outpacing inflation. Imagine the relief of knowing your income stream grows faster than your living expenses rise. Financial security that adjusts automatically to protect your lifestyle. Want to accelerate your journey? Increasing your monthly contribution from $400 to $500 or $600 creates dramatic results. This relatively small adjustment significantly speeds up your timeline to financial freedom. The math of compound returns means even modest increases in your contribution rate can shave years off your journey. Next time you consider that daily specialty coffee, consider the future it could brew for you instead. Started later in life? The principles remain unchanged, though timelines adjust. A 45-year-old beginning this strategy might not reach the full 1.48 million, but could still build substantial dividend income by traditional retirement age. The approach works regardless of your starting point. Simply adjust the variables, contribution amount, time horizon, or target income. Perhaps the most profound benefit is psychological. Reaching the point where your investments generate significant income fundamentally changes your relationship with work. You gain the freedom to work because you want to, not because you need to. Career decisions become about fulfillment rather than necessity. Bad bosses and toxic workplaces lose their power when you know your basic needs are covered by investment income. Imagine the peace of mind knowing your bills will be paid whether you work or not. Think about the options available when you can decline unappealing assignments, negotiate better conditions, or take extended breaks without financial stress. This psychological freedom represents the true value of building a portfolio that outperforms traditional employment. The path to this freedom is straightforward. It doesn't require sophisticated investment knowledge or timing the market. It simply demands consistency. $100 weekly contributions combined with patience and time. The mathematics of compound returns does the heavy lifting, transforming modest, regular investments into a self-sustaining income machine. The wealth-building path we've outlined isn't just a strategy. It's a financial lifeline in a country where approximately 60% of Americans have less than $1,000 saved for retirement. The majority of people in one of the world's wealthiest nations are financially unprepared for their future. This alarming reality is why consistency, time, and compound returns work together so powerfully. When financial experts analyze successful wealth building, they consistently highlight these three elements as the foundation. Yet nearly 40% of Americans aren't on track to achieve financial freedom. The decision to invest $100 weekly isn't about whether you can afford it. It's about whether you can afford not to. Every week you delay is potential growth forever lost. What if choosing to invest $100 a week through vehicles like SCHD means rewriting your financial destiny?